All right, for chapter 1, it's basically definition, terminology, that sort of thing. But they do start on page 3 here. And the company profile is by costume. Which is actually a Wisconsin company. They're out of Waukesha. So again, each chapter, if you remember from cost, starts with a company overview or company profile. And those are always nice to kind of review and kind of get a grasp of what the chapter is about. And again, the managerial, it's a lot, how can I relate it to what I'm doing at work? So that's kind of the goal here with each of these chapter profiles. The discussion begins as to what is a definition of managerial accounting. It's basically what the company chooses to track. And when you read about buy costumes, they talk about what they're tracking as far as not only financial numbers, but also how their hits are on their websites, how long does it take to place an order on their website, how many people go in and come out without buying anything. And they look at all those analytics to determine how well they're really doing with their operation. We are not bound by GAAP, so this is totally different than intermediate, which is. So we can basically track and do and report how we wish to. The goal of managerial, there's 3 of them. We got a plan. Through that planning process, we're hoping to control our operation and then make better decisions, right? So this planning process is in the form of budgets. So a lot of managerial, we'll be looking at budgets, setting budgets, looking at financial ratios, there'll be a little bit of costing again, still within managerial, but then using those budgets for controlling. And that controlling aspect is defined very nicely here. And this is on page 4. How do we control? And so many small companies don't do this process. You control by comparing. You compare your actual performance to your budget, right? That's the goal with managerial accounting. It's hard to say to somebody on the operation floor, you're not making enough parts when they don't know the plan. What was the budget for them, right? Or, gosh, your cost in your department is way over. Well, again, what was the plan? And that's where this expected performance comes in. Through a budget. Right? And that's kind of what we're going to do. Hopefully, we can then use that information to make a better decision. And that's the third part of our course here. How do we make good decisions with the information that we have? There's some really good how's it used in chapter 1. They talk about Costco and their choice as to whether they're looking at buying coffee from Rwanda for the quality and what goes into that decision. Price, right? Shelf life, sustainability. Can they sustain those farmers in Rwanda? Do they have the ability to sustain the production level needed to supply the Costco stores? Politically, how stable is Rwanda? What tariffs are being put in place? You hear a lot of the word tariff in the news recently. So that's all part of that decision process. So take a look at those. That was on page 6. Yep. and kind of gives you a feel as to what management has to consider in their decision process. All right. The book then goes into more depth, the differences between financial and managerial accounting. And there's a nice table on page 8 that discusses this difference. Please know this table for the test. It is this table right here. Financial is external focus. We're over here under managerial. We are internal focused, right? Financial, you're GAAP compliant, whereas managerial, we're not. Financial is more historical. Managerial, we're more on that planning budget side, right? And we cover not just numbers, we might look at number of lates, number of warranty claims, number of reworks, how many hours does it take to make something. We're looking at different information to help us better manage our operation. So that's where this non-financial is really prevalent in our focus, right? In what we're doing on a daily basis. So take a look at that. Even they talk about on page 8, I'm just throwing this one out here. Degree of aggregation. And that basically means how much cross-training is there. To keep an operation going, if somebody's sick on a particular day, right, can someone else fill in? Or if we do have to fire somebody, is there somebody else trained in operating that machine? That's part of our focus as well. How can we keep this operation as efficient as possible? Degree of aggregation. Some more definitions just coming through here. Let me just try to find it here if I can. Oh, here. Tonight, this is laid out in chapter 1, but chapter 5 is where we're going next. We're going to talk about ABC costing. It's a new cost method approach to assign overhead. I got a cost question here, guys. What does assign overhead mean? Assign it to what?
Assign to actual. We have to predetermine, expect the rate, and then apply for the.
Yes, very good, Cherie. Yeah, it's an estimate, right?
Yes.
Of our overhead dollars, and we're assigning it to work in process inventory. So it's a new way of doing that. In the old days, or in many companies still prevalent, we use machine hours. So if a job took 2 machine hours and our predetermined rate was 10, we would assign $20 to it for that particular function. So, but this is going to use different drivers, different ways to assign that overhead. And that's really what Chapter 5 is about. And the reason some companies are using this method is, one, we have computers. We can track a lot more numbers than just machine hours in today's world. And two is the competitiveness that we're in. We have to be sure our costs are accurate. So it's a very good system for some companies. So just definition, we'll come to that shortly. The book then talks about this managerial focus, starting with page 9, 10. We're customer focused, not just internal, right? We got to look at what the customer values in our operation, because again, we want to be sure that they are willing to pay for what we're doing. We always want to lower costs and look at processes within our operation. Is everything we do in our operation necessary? Is that what a customer will pay for? So we're going to look at value-added versus non-value-added operations within our process, and then hopefully eliminate some of that unneeded or non-valued processing. I like this one. This is on page 10. Everybody knows who UPS is. They invested hundreds of millions of dollars in a computer platform to help managers and drivers determine the best delivery routes. Took 50 engineers, a 1,000-page program to do this process. And it talks about, and I read this in another article, why do UPS drivers only make right turns? Less accidents, and it's quicker than making a left turn. So you might have to actually drive longer to always make a right turn, but it's still safer and quicker than making a left-hand turn. So stuff like that, it's very impressive, and from this they were able to save like 500 million or something every year. So it's amazing how well that this program worked for them. So that's what I mean. Process evaluation is part of that managerial focus. Other terminology I would like you to know, what's our strategy? How does a company compete? Is the company going to use a cost strategy, or is the company going to use a product strategy, a value strategy? Walmart basically falls in this strategy, and the book talks about Target being in this sphere. Cost or product differentiation through the value part of it. So strategy means, strategic means strategy. Another term called value chain. What does that mean? It's our whole operation, basically, from beginning to end. They have a nice chart. Here's the value chain. In cost accounting, we were just here in the middle. Managerial, we're going to do the whole value chain from research and development through our production, through our delivery and sales, and finally, how do we service our customers after the sale? So that's our whole scope in management accounting. So know the term value chain. What does that mean? We have another snippet on buy costumes, just again on page 11. And since we're looking at the value chain, we're going to be looking at a cross-functional perspective, not just looking at our costs, material, labor, and overhead, but how we, again, process through the value chain our product or service. So it's all-encompassing, not just the cost approach. Again, this is stuff that I'm just whizzing through these. I'm just trying to lay it out. You don't have to take a lot of notes. It's pretty straightforward in the book. So don't be too concerned if you're not getting this. I'm just kind of going through this. TQM, you do need to know this definition. This is on page 11 also. And the concept of continuous improvement. In management, we're always looking at ways to reduce waste, not only in our product, but in our process, right? How we make things. And I think they talk about here, BMW had 50 styles of steering wheels for their cars. They were able to bring it down to like 5 or 8 or some lower number, significant. It was a huge cost savings for the company. Not giving everything to a customer that they may want. You got a management decision as to how much you want to offer. And that's where this efficiency in reducing waste is. Not to mention the inventory that you got to maintain. TQM, total quality management. Our goal here with TQM is to have 0 defects. So when the customer gets that product, it's always going to work 100% of the time. There won't be any defects at all. That's the goal. Now whether you hit that mark is irrelevant. You're trying to get as close and always continually improve to meet that goal. And since we are looking at reducing our processing, we are also looking at our accounting department. Lean accounting, organizing costs, reporting changes, obviously, to meet the demand of our production department, our sales department. Remember, we have to look at the entire organization now. What do we in accounting need to do to make sure they have the information necessary to make effective decisions? So it's not just the production, it's also in our department. So those are just some of the things that you'll see within Chapter 1. And this is kind of important, enterprise risk management. What happened in Alabama over the weekend, tornado, right? Enterprise risk management is, again, as accountants, we have to prepare for disasters. What do we do if we lose electricity? What do we do if our plant is suddenly destroyed and we got to find another location? They talk about Walmart and Katrina. The hurricane. How do we supply the materials and to restock our stores once the stores were wiped out, right? how do we get our product back into those stores as quickly as possible. And they talk about them being better prepared than the U.S. government as far as revitalizing that area. So what can we do to do that process better and more efficient? Also in this enterprise risk management, they talk about a company's sustainability. What does that mean when a company says they talk about their sustainability? Anybody know? I've been doing a lot of talking. You guys?
How long they can stay in business for.
Yeah, yeah. Not only the company stay in business, but also under this, their environmental footprint, right? What effect are we doing to our environment? We want the long range look here. We want to be able to make sure our products, what we do, is not causing more damage than we have to our environment. Quite a difference in philosophy when we used to dump a lot of stuff in the Fox River. A lot of our manufacturing plants didn't really care about the quality of the water at that point. Today we do, right? We have to. We can't keep doing the damage that we sometimes do. So that's part of this also process. What can we do? And in fact, this is reported on in the SEC filings because many times investors want to know that. Are they investing in companies that are thinking about their sustainability and what they can do to reduce this environmental damage if there is any? All right. Time, right? So we're going to talk about efficiency. Here's what they're talking about. Value added versus non-value added. Improving efficiency. I think we understand that term. Even reducing our inventory levels really helps to reduce our cost, that sort of thing, right? Now, there is a test question on this. This is on page 13. It's worth 3 points. How do I know it's 3 points? Because a lot of times students miss it. Okay. A line position versus a staff position. Know the difference between a line position and a staff position. When we say line position, what do we think of in our brain without looking?
Something in line.
On the production line. It's totally opposite. A line position is the CEO, the VP of finance, the VP of sales. They are the ones that are setting the strategic direction of the company. They are the ones that are setting the goals or objectives to meet that strategy. VP of finance, VP of sales, chief operating officer, right? The big officers of a company. As opposed to whose staff? We are. We are the accountants, right? Controller. That's support. We support the line personnel.
So line position is the controller?
No.
No?
Staff. We're staff.
The staff is the
Staff is controller, as an example of a staff person.
Oh, okay.
Line is CEO, VP of Finance, VP of Sales. They're actually setting the strategy. We are supporting it with our information. Is everybody clear on that definition? So be watching for that. What's the difference between a treasurer and a controller? What does a treasurer do for a company?
Financial aspect.
Yes. If I need money, right, I go to the bank. I'm the treasurer of that company. So whether I go to the bank or I issue stock, where am I going to get my money? Controller, what do they do? We prepare the what? The statements. We're responsible controlling our operation, basically. That's the word controller. So we are there to provide the information needed for the SEC or for whoever, the bank. If you work for a government, you're considered what? Not a controller, but what? It's not used too much anymore. Comptroller. Comptroller, if you've heard of that team. That's a government accountant. Okay, ethics. This is your ethic lesson. You all have taken ethics, right? Are you more ethical now that you took ethics? Hopefully, right? Can I have you go to page 19? Page 19. Exhibit 1-4. Know the difference between competency versus confidentiality versus integrity versus credibility. Different terms for that ethics. Ethics covers all of these aspects. As accountants, you need to be competent, which means you need training. I go to training every year, right? You got to keep up on your skills. Confidentiality. What does that mean?
Means keeping things, you know,
Quiet.
to yourself.
To yourself. What are we talking about?
Confidential?
Important information about a.
We got to keep the records from getting out, right? I've had somebody go through my payroll files at work, found out what everybody's wage was. Did I do my job? Nope. I got in a lot of trouble for that. Because I didn't have a lock on the cabinet, which I should have. Or, this is not what I... You ever go to a bar? Are you 18 or 21? I'm sorry. Maybe I should ask that first. Have you ever been in a bar and heard, if you've been to one, have you ever heard somebody complain about their company? Oh, yes. Oh, they're going bankrupt. Have you heard that? Oh, sure. Oh, we really did a bad month this month, or we didn't ship this month, or whatever the case may be. That's what I'm talking about. I've had a person get fired because they were talking like that in a bar. That's confidentiality, right? I don't even tell my wife whether a company's doing well or not well, because I don't want to put her in that position. It might accidentally slip, right? That's what I'm talking. Now, integrity, mitigate conflicts of interest. You ever hear somebody taking some internal information, selling their stock before it went tanked? Happens all the time. Look at, what's her name? Who's the lady? Martha Stewart. Very good, Amber. Yes, that's where that comes into place. She got jail time for that. And then credibility. fairly and objectively report the information, right? Even if it's bad, you got to report it. You have no choice. Now, what I would like you to look at is the resolution of conflict. Take a few minutes. I'm going to stop my recording. I want you to read this paragraph. Please, if you can stop what you're doing, it's really important that you read that paragraph, please. Do I go to Channel 11 News and say, hey, this is happening? No. What do I do first?
Supervisor.
Immediate supervisor. If they're involved, who do you go to next? Their supervisor if you can't get a resolution. Where do you go next?
Management.
Upper management. And then?
Chief. At the chief or CEO.
Yep, chief executive officer or audit committee, right? If I don't get a resolution there, where do I go?
Go to the board director, the board, or the board.
Yeah, the board of directors, right? If there is such a thing for a company, the board of directors. If I don't get resolution there, where do I go? Or owners, board of director owners. Get a good lawyer, right?
Yeah.
Because what can a company do if you say something that they don't want to get out? Even if it's true or not true, it doesn't matter.
Anything.
They can sue you for defamation, right? And it could be in the courts for years. So, fortunately, I've never been in that position. But you working for many, many different companies, you might be in that position. So again, confidentiality, right, is paramount. You've got to go through the order of resolution, right? You can't just go out there and say something to somebody because you can get in a huge lawsuit. So keep that in mind. Lots of things to consider about when you're looking at your ethical behavior. Did they talk about that in ethics? Do you remember that class? No? It's not an easy task to be ethical in business. Trust me. You are going to be asked to do things that you will know is not ethical. So it's going to be your judgment at that point. I won't tell you mine. All right. So it talks about shady industries and so forth. Also, many companies have this. If you're starting new somewhere, you have to sign a code of conduct, right? There's a reason for that. Confidentiality again. And you have to act a certain way. Is it a good idea if you're the accountant for a company and you go to the bar and you get a DWI? No, it doesn't. Right? So something to think about. Okay. The last part of Chapter 1 are the certifications available to accountants. There is a CMA certification, a CPA certification, internal audit certification. Just know for your own reference. And it depends on what career path you wish to choose. I was here. I still have my license, but I don't practice anymore. But I still maintain my educational requirements and reporting requirements for that license. Kathy Sternetsky has both of these. She has both a CMA and a CPA. She's teaching here now. I've not known of anybody that has their internal auditing. Mostly those are bank-related kind of certification requirements. All right. That's all I have. And who's going on to school after here? No one? If you think about it, if you do think about going on to school to get your 4-year degree, You do need that to get or sit for the exam, the CPA. You do need, well, now it's a 5-year, 150 credits is required to sit for the CPA exam. And this is one of the reasons why there's a shortage of accountants for the CPA. All right. That's all I have.
I don't understand chapter 5.
Chapter 5 is unique. Let's just say that.